Okay, so we're all living in this new age of investing, right? It's all about AI. But what happens when the machines get too good? I mean, really, really good. That's exactly what we're going to dig into today.
So here's the big, kind of scary question that should be keeping every investor up at night. What if an AI could perfectly predict the market, like flawlessly? And what if everyone had access to that prediction and acted on it? Would all the profits just vanish for good?
Well, the answer is no, and that might surprise you. Profits aren't disappearing, not at all. They're just moving. They're shifting, changing where they come from, and more importantly, who gets to pocket them.
And this whole idea leads us to something really fascinating, something called the AI prediction paradox. See, a market that's perfectly predicted doesn't just break, it actually changes its shape, it transforms itself because it's being predicted.
Okay, here's how it works. It's actually pretty simple. The moment a perfect prediction gets out, what does everyone do? They all rush to act on it, right? But that massive collective action instantly changes the market. The very act of following the prediction makes the prediction worthless. It's like the market is alive and it's actively fighting back to invalidate any forecast that tries to pin it down.
So if a perfect prediction basically self-destructs, then why do profits still exist? Why doesn't it all just go to zero? Well, it turns out there are three really solid reasons why that whole zero profit market idea is just a myth. All right, reason number one, the real world is just messy, you know? Even if we all got the exact same perfect AI signal, we couldn't all act on it in the same way. People have different amounts of money, they're dealing with different regulations, different timelines, different stomach for risk. All of that creates friction. And that friction, it creates gaps. Things like front-running or market overshoots. And right there, in those gaps, that's where profit opportunities pop up.
Second, and this is a big one, we have to remember what an AI is actually giving us. It's not a crystal ball showing a certain future. It's handing us a map of probabilities. And that means there's always room for the wild, the unexpected. You know, the black swan events, the sudden panics, the stuff no model could ever see coming. It's in those moments of chaos, those market distortions, that's where you find what they call excess returns, the real profits that beat the average.
And that brings us to the third, and maybe the most important reason of all. We get this wrong all the time. We think the market is a prediction machine. It's not. Its real job, its fundamental purpose, is to be a risk transfer device. It's a system for moving risk from people who don't want it to people who are willing to take it on for a reward. In this new AI world, that reward doesn't go away. It just gets a lot more concentrated, going to the people who are truly willing to bear that risk.
Okay, so profits aren't vanishing, they're just moving. That means we need a new map for this new world. So let's break down who the winners and losers are going to be now that AI is changing all the rules. And man, this new reality creates a huge divide. On one side, you've got the dying strategies. Basically, anything that relies on you trying to be faster or smarter than a machine. That's a fool's errand, a losing battle. But on the other side, you have the strategies that survive and even thrive. These are the ones that lean into things only humans can do well. Real long-term patience, being comfortable with ambiguity, and having the guts to just hang on through the tough times.
So to play in this new game, you need a totally new mindset, a new mental model. And funny enough, to find one that's perfect for this super modern problem, we're going to look to a really old, powerful philosophy from Japan.
And that concept is Wabi Sabi. Now, you might have heard of it as an aesthetic thing, for pottery or design, but at its heart, it's a super practical way of looking at the world. It's a framework for dealing with things that are, by their very nature, imperfect, temporary, and incomplete. And what does that sound like? It sounds exactly like the stock market.
So let's see how we can translate this philosophy into an actual financial strategy. First, imperfection. That just means accepting that no model, no matter how smart, is ever perfect. Then there's impermanence. That means understanding that every single strategy will eventually stop working. And then there's empty space. And this one is so important. It's about the value of doing nothing, the value of reserving judgment and leaving room for the unknown to happen.
And this really gets to the heart of the difference. On one hand, you've got risk. Think of risk as calculable probabilities, like the odds at a poker table. AI is the absolute master of this domain. But then, on the other hand, you have true uncertainty. This is the stuff you can't even put a number on. It's completely unknowable. And this is where AI is fundamentally weak. This is the Wabi Sabi investor's home turf. This is where we find our edge.
Okay, this all sounds great in theory, but how do we actually do it? Let's get practical. We're going to break this whole philosophy down into 7 actionable principles. Think of it as your Wabi Sabi investing toolkit.
All right, the first 3 principles are all about fighting our worst instincts. Principle number 1, always hold a small amount of stuff you can't quite explain. Embrace that imperfection. Principle 2, change how you think about patience. When the market is flat and nothing's happening, don't see it as a failure. See it as a success, as a time of preparation. And number 3, be a classic contrarian. Quietly reduce your positions when everyone and their grandmother is screaming about it on the news. Act when it's quiet, not when it's loud.
Now, principle number 4, this might be the toughest one. It requires a complete rewiring of our emotional response to the market, and it's all about one thing: how you handle your losses.
There's this amazing Japanese phrase that just nails it. It says to treat unrealized losses as part of the scenery. Think about that. Don't see a portfolio in the red as some huge mistake you need to fix immediately. See it as part of the natural landscape. It's like a rainy day or a passing storm. It's temporary. It's just part of the journey. This is all about building true emotional resilience.
Okay, let's lock in the strategy with the last 3 rules. Number 5, go where the AI hates to go. We're talking low liquidity, ambiguous situations, messy data. Avoid the competition. Number 6, completely change your scorecard. Stop judging your portfolio by annual returns. Instead, judge it by endurance time. Ask, how long can this thing survive a storm? And finally, number 7, the big one. Systematize the courage to do nothing. Make inaction an active, deliberate, strategic choice.
So, when you put it all together, what does it all mean? It boils down to this. AI is going to claim all the average predictable returns. That game, it's over for us humans. But the excess returns, the alpha, the profits that come from chaos, from true patience, from embracing uncertainty, that's what's left for us.
What this means is that your role as an investor has fundamentally changed. Your job is no longer to be a better predictor than a machine. You can't win that. Your new job, your real source of value, is to be a willing, patient, and resilient bearer of the kinds of risks that an AI just can't touch. And that's the big shift. The entire age of the predictor is over. The age of the risk bearer has just begun. So the only real question left is, are you ready to become one?